This presentation focuses on the law of business and business organizations, with a special emphasis on limited liability companies, or LLCs. LLCs are a modern and popular business structure designed primarily to protect the personal assets of the owners by separating personal risk from the business activities. This means that if the business faces financial trouble or legal claims, the owner's personal finances are usually shielded. As we go through this presentation, we'll explore why LLCs are considered the ideal blend of flexibility and protection for entrepreneurs today. An LLC, or limited liability company, is a type of business entity that blends the best features of a corporation and a partnership. What makes it unique is that it offers limited liability protection, much like a corporation, meaning the owners are generally not personally responsible for the company's debts or liabilities. At the same time, it maintains the flexibility of a partnership, allowing for simpler management. Let's take a closer look at the origins of the limited liability company, or LLC. It all started in 1977, when Wyoming became the first state to authorize an LLC statute. This new business form was a hybrid, combining the flexibility of partnerships with the liability protections typically found in corporations. This was significant because it laid down the legal framework for an entity designed to meet the needs of modern businesses. Moving into the 1980s, adoption of the LLC was cautious and inconsistent. Many businesses were hesitant to embrace this structure, largely due to uncertain tax treatment at the federal level. Without clear tax guidance, the LLC remained promising in concept, but carried practical risks, which slowed its broader acceptance across different states. By the 1990s, however, the landscape changed dramatically. Following favorable tax recognition, states began to rapidly adopt LLC statutes. This nationwide acceptance made the LLC a mainstream choice for business owners who wanted the benefits of limited liability while maintaining operational flexibility. This timeline from 1977 through the 1990s shows how the LLC evolved from a novel idea into a widely accepted business form. Let's look at the three main business entity types and how they compare in key areas. First, the LLC, which is a hybrid form offering a balance between partnership flexibility and corporate structure. Members in an LLC usually have their personal liability protected, and for taxation, it can be treated either as pass-through income or elect to be taxed as a corporation. Ownership is defined by members holding interests, and since it's contract-driven, there are fewer formalities involved. Next, the corporation stands as a separate legal entity. Shareholders also generally have liability protection. However, taxation is often at the entity level, meaning the corporation pays taxes on its income. Ownership is based on shares, and there are formal requirements like boards of directors, regular meetings, and record-keeping. Finally, the default association is the partnership. Here, general partners are personally liable for business debts. Taxation usually flows through to the partners individually. Partners share control over the business, and compared to corporations and LLCs, partnerships have the least formal requirements. In summary, the choice between these entities depends on the desired balance of liability protection, tax treatment, ownership structure, and the level of formality in management. The LLC offers a flexible middle ground, combining benefits from both partnerships and corporations. Now let's talk about the fundamental concept of limited liability, which is central to business organizations. The key point here is that members of an LLC are generally not personally responsible for the company's debts or legal judgments. This means that if creditors come after the business, they can only pursue the assets owned by the LLC itself, not the personal belongings, homes, or savings of its members. In the case of lawsuits, even if there is a judgment against the company, it doesn't automatically make the members personally liable. This protection is what makes limited liability so valuable. And when it comes to bankruptcy, if the LLC fails financially, the members typically lose only the money they invested in the business, rather than facing personal financial ruin. This core protection encourages entrepreneurship by reducing personal risk. Here we're focusing on member protection within an LLC. When a liability event occurs, such as a customer suing the business after an injury on company property, The key point is how the LLC structure shields its members. The claim is made against the LLC itself, not against the individual members personally. This means that personal assets like homes, savings, and cars are typically protected and not at risk in the lawsuit. Essentially, the LLC acts as a separate legal entity, absorbing the business risk without automatically exposing each owner to personal financial loss. This separation is what makes the LLC a valuable choice for protecting members from certain liabilities. When forming an LLC, there's a clear sequence of steps that establish both its legal existence and how it will operate. First, you need to file the Articles of Organization. This document officially registers your LLC with the state. Next, obtaining an EIN, or Employer Identification Number, is crucial as it's used for tax purposes and opening business accounts. Then, you'll create the operating agreement, which outlines the management structure and rules for the LLC. Finally, don't forget to register for any required state permits or licenses to ensure your business complies with local regulations. Following these steps carefully sets a solid foundation for your LLC. Now let's talk about the Articles of Organization, which are fundamental to forming an LLC. This is the foundational public filing that legally brings the LLC into existence. Key details included here are the LLC's name, the principal place of business, and the registered agent, who is responsible for receiving official documents. It also lists the names of the members involved, outlines the management structure, and includes the required filing fee. This document is submitted to the state, making it an essential step in the creation of any LLC. Understanding these components helps ensure the LLC is properly established and compliant with state laws. Now let's talk about the operating agreement, which is a crucial document for an LLC. Although most states don't legally require it, having an operating agreement is essential in practice because it serves as the LLC's governing document. One of the key components it covers is member rights. This means it clearly defines each member's ownership interest, their voting rights, and their economic entitlements. It also addresses how profits and losses are distributed among members, often allowing for arrangements that go beyond the default rules set by law. Another important aspect is decision-making authority. The operating agreement spells out who controls the business and specifies what approvals are needed for major actions. Overall, the operating agreement helps prevent confusion and conflicts by setting clear guidelines on how the LLC operates. Now let's dive into the key aspects of business taxation and organization structures. First, the default taxation for an LLC is that profits and losses pass directly to the owners. This pass-through taxation is often favored because it simplifies reporting, avoids double taxation, and suits closely held businesses well. However, an LLC also has the option to elect corporate tax treatment, either as a C Corp or an S Corp. This optional election becomes beneficial in situations involving reinvestment strategies, payroll management, or planning for growth. Essentially, the choice of tax structure gives businesses flexibility to align their tax obligations with their specific financial goals and operational needs. Understanding these options is crucial for making informed decisions about how to structure your business for tax efficiency. Here we see how taxation flexibility works within an LLC. The key idea is pass-through taxation, meaning the business entity itself is not taxed on its income. Instead, the income passes directly through to the members of the LLC. Each member then reports their share of the business income on their individual tax returns. So, for example, Member 1, Member 2, and Member 3 each include their portion of the earnings on their personal tax forms. This approach avoids the double taxation typically seen in corporations, where both the business and its owners are taxed. It's an important feature that makes LLCs attractive for many business owners. When it comes to managing an LLC, there are two main structures to consider: member-managed and manager-managed. In a member-managed LLC, all members share the responsibility of making ordinary decisions and handling the day-to-day operations. Each member has management rights, meaning decision-making power is distributed equally among the ownership group. This setup works well when all members want to be directly involved in running the business. On the other hand, In a manager-managed LLC, the members appoint one or more managers to handle the day-to-day operations. Here, the members retain ownership, but delegate operational authority to the designated manager or managers. This centralizes decision-making power, making it easier for the managers to run the business efficiently without requiring constant input from all members. This structure is often chosen when some members prefer a more passive role. Understanding these options is crucial for defining how your LLC will operate and who will have control over its management decisions. Here, we're looking at the distinction between a member and a manager in the context of business organizations, specifically within an LLC. In a member-managed LLC, this distinction becomes less clear because the owners themselves manage the day-to-day operations, so the member is essentially the owner, holding both the economic interest and the voting rights in the company. On the other hand, the manager acts as the operator, the person responsible for making contracts, decisions, and handling the daily business activities. In many cases, especially in member-managed LLCs, these roles overlap, with members actively participating in running the business rather than just owning it passively. This structure emphasizes the dual role of members as both investors and operators. Here, we're focusing on the concept of piercing the veil in business law. This is a key legal doctrine that allows courts to ignore the limited liability protection an LLC usually provides. In extreme cases, the court can hold the individual members personally responsible for the company's debts or actions. There are three main situations where this can happen. First is fraud. If the LLC is used to deceive creditors, customers, or the court, the protection can be lifted. Second is commingling, which means mixing personal and business funds as if they were the same. This blurs the lines and can lead to personal liability. Third is undercapitalization, which occurs when a company starts or operates without enough funds to meet its expected obligations. In these cases, courts may decide that members should be personally accountable to ensure fairness and justice. Understanding these conditions is crucial for anyone involved in business organizations because it highlights the importance of maintaining proper separation and adequate funding to protect personal assets. Now let's talk about piercing the corporate veil, a critical concept in business law. Piercing occurs when a court decides to hold the members of an LLC personally liable for the company's obligations. This usually happens under certain circumstances. First, fraud or misconduct. If the members use the LLC to deceive creditors, hide assets, or engage in wrongful acts, courts can step in and pierce the veil. Second, inadequate capitalization. When a business is intentionally underfunded from the very beginning, the court may consider the LLC just a shell designed to avoid paying debts or liabilities. Third, failure to maintain formalities. For example, if members mix personal and business funds or ignore proper record keeping, it shows the LLC isn't really separate from its owners, which can lead to veil piercing. Understanding these key triggers is essential for both protecting your business and avoiding personal liability. When we talk about ownership and capital contributions in an LLC, it's important to understand how members invest and share in the business. First, each member holds what we call a membership interest, which is essentially their ownership stake. This stake is clearly defined in the operating agreement, ensuring everyone knows where they stand. Next, capital contributions. That's how members fund the business. This can come in different forms like cash, property, or even services. It's flexible, depending on what the members agree upon. Then we have profit and loss allocations. These don't always line up exactly with ownership percentages. Instead, economic rights can follow the terms agreed in the operating agreement, offering some customization on how profits and losses are shared. Finally, transfer restrictions. Ownership interests in an LLC often can't be transferred freely. Usually, members need to get consent from the others before they can sell or transfer their interest, which helps maintain control within the group. All these elements work together to define how ownership and capital function within the LLC structure. When we talk about transferability of membership interests in an LLC, it's important to understand the distinction between economic rights and control rights. Essentially, the value or economic benefits associated with a membership interest, like the right to receive distributions and the member's share of profits and losses, can generally be transferred. This is often done through what we call an assignee, who gets the financial interest. However, what you usually cannot transfer without explicit consent are the governance rights. This includes voting rights, management authority, and full member status. These control aspects are typically restricted because they impact how the LLC operates and makes decisions. The operating agreement or state law often plays a key role in setting these boundaries. So, the takeaway here is that while members can transfer their economic interests relatively freely, transferring control and decision-making power is much more limited and usually requires approval. This balance helps maintain stability and ensures the LLC functions as intended by its members. Now, let's look at the rights and duties of members within business organizations. Members have important rights, such as access to information, which ensures transparency and allows them to stay informed about the business's activities. They also have the right to sharing profit distributions, reflecting their stake in the company's success. Additionally, members can vote on major decisions, giving them a direct say in the direction of the business. On the flip side, members also have specific duties they must fulfill. One key duty is the fiduciary duty, which means they must act in the best interests of the business and other members. They are also expected to comply with the operating agreement, adhering to the rules and guidelines set forth for the organization. Another important obligation is capital maintenance, ensuring the business's financial stability is preserved. Understanding these rights and duties is crucial for maintaining a balanced and effective business partnership. It helps protect everyone's interests while promoting smooth operation and growth. Here we're focusing on the editorial and fiduciary standards that govern the responsibilities of those in control of a business, particularly within LLCs. The key idea is that power over a business comes with duties to act in the business's best interest, not against it. For members and managers of LLCs, fiduciary duties can apply unless they're specifically changed by law or the operating agreement. One of the most critical duties is the duty of loyalty. This means putting the LLC first, avoiding any self-dealing, secret profits, or competing with the company. Next is the duty of care, which requires acting with informed judgment. If decisions are grossly reckless or negligent, this can lead to liability. It's also important to act in good faith. This means exercising your authority honestly, fairly, and in a way that aligns with the company's purpose. In essence, the duty you owe follows the discretion you have. Reinforcing that, with control comes a responsibility to act appropriately and ethically. When we talk about dissolution and winding up in a business context, it's important to understand that ending a business entity isn't just a single event. It's a process with several key steps. First, there's the trigger event. This might be a member leaving, the business reaching its predetermined expiration date, or a unanimous vote by members to dissolve the entity. This event activates the dissolution rights outlined in the operating agreement. Next comes formal dissolution. At this stage, the LLC must follow specific legal steps, including filing the necessary termination documents with the state to officially begin the dissolution process. After formal dissolution, we move into asset liquidation, where the business sells off its assets to generate cash. That cash is then used to pay off any outstanding debts and obligations the business owes. Finally, the last step is the final distribution of any remaining value. Once debts are settled, what's left is distributed to the members according to the rules set out in the operating agreement. This structured approach ensures the business is closed down properly and fairly for all parties involved. When a member leaves an LLC, you might wonder if the whole company automatically dissolves. The answer is not necessarily. It really depends on what the operating agreement says. Most LLCs are actually set up to keep going even after a member departs, allowing the remaining members to continue the business without interruption. So, continuity is usually built into the structure unless there's a specific clause that says otherwise. Understanding this is key because it affects how stable and lasting the LLC can be over time. When considering the formation of an LLC, it's important to understand that statutory requirements vary significantly depending on the jurisdiction. LLC rules are far from uniform, and factors like filing burden, taxes, and liability treatment can differ quite a bit from one state to another. For example, Wyoming offers a very easy and low-cost filing process with minimal annual reporting requirements. Their fees are low, and they have a reputation for strong asset protection, which can be a major advantage. Delaware is also a popular choice due to its predictable statutes and efficient processes. While the filing is relatively easy and the annual franchise tax is moderate, it has a more developed case law regarding liability and compliance. However, the registered agent compliance is something to watch for there. California, on the other hand, is more involved. It requires specific forms and fees during formation and robust ongoing annual reporting. The franchise tax here is high, which can increase the overall cost of maintaining an LLC. Compliance is also more formal, which raises the importance of careful management. Ultimately, the choice of state for your LLC can significantly affect your costs, compliance obligations, and legal risk exposure. It's critical to weigh these factors carefully based on your business needs. When business owners decide on the best structure for their company, many choose to form an LLC or limited liability company because it strikes a great balance between protection, flexibility, and simplicity. One of the main reasons is liability protection. LLC members typically aren't personally on the hook for everyday business debts or legal claims, which provides peace of mind and safeguards personal assets. Another key advantage is tax flexibility. An LLC often allows owners to choose pass-through taxation, where profits are reported on their personal tax returns, or to elect to be taxed as a corporation if that makes more financial sense. This adaptability helps tailor tax treatment to the specific needs of the business. Management freedom is also a big draw. Instead of being bound by the formal and sometimes restrictive rules that govern corporations, LLC owners can decide how they want to run the company, whether that means the members themselves manage it or appoint managers to handle operations. Lastly, LLCs usually come with a lower compliance burden. Compared to corporations, they face fewer ongoing governance requirements, making it simpler and less costly to maintain good standing. Overall, this combination of protection and room to grow is why so many small and growing businesses opt for an LLC structure. On this slide, we're comparing LLCs and S corporations, focusing on the key differences in liability protection, taxation, self-employment tax, compliance complexity, and the costs to form and maintain these entities. Both LLCs and S corps offer a strong liability shield, protecting members or shareholders from personal liability in most cases. However, when it comes to taxation, LLCs generally offer more flexibility with a default pass-through treatment, meaning profits and losses flow directly to members and are taxed on their personal returns. This pass-through often applies to all earnings that are actively earned. In contrast, S corporations also provide pass-through taxation, but only if specific IRS rules are met. One advantage here is the potential to reduce self-employment tax by splitting income between salary and distributions, which can lead to tax savings. Regarding compliance, LLCs tend to have lighter formalities and are simpler to manage, making their maintenance usually less costly and complex. S corps, however, must adhere to stricter rules, including payroll requirements and more filings, resulting in higher ongoing expenses and administrative burden. In summary, while both entities provide similar liability protection, the decision really hinges on the different tax and compliance trade-offs. This comparison should help you weigh what's most important for your business needs, whether it's simplicity and flexibility or potential tax advantages through more structured requirements. Before forming an LLC, it's crucial to get the right advice to ensure everything is set up correctly from the start. One of the first steps is to consult a CPA, because tax treatment can vary widely. A professional can help align your LLC structure with your financial goals, potentially saving you money and headaches down the line. Next, it's important to review your state laws. Every state has different formation rules, annual filing requirements, and compliance obligations, and these differences can significantly impact how your business operates. Lastly, customizing your operating agreement is essential. A well-crafted agreement clearly defines management roles, ownership rights, and procedures for resolving disputes, which helps prevent conflicts before they even arise. Taking these professional considerations seriously will set a strong foundation for your LLC's success. Now let's talk about some common pitfalls that businesses, especially LLCs, often face. First, inadequate capitalization is a big one. If a company starts off underfunded, it can look like it was never really set up to meet its financial obligations, which can cause serious problems down the line. Next, having no operating agreement is risky. Without clear written rules, any disputes are left to be resolved by state law, which can lead to confusion and lack of control over how the business operates. Poor record keeping is another major issue. When important documents like minutes, contracts, and financial records are missing, it weakens the evidence that the company operates as a separate entity, which can be damaging legally. Mixing personal and business finances is a classic mistake. Commingling funds can be used to challenge the limits. As we look ahead to the future of LLCs, there are several important trends to keep in mind. First, in terms of adoption, LLCs are becoming increasingly popular, consistently outpacing older business structures for new ventures. This shows how attractive LLCs are for entrepreneurs seeking flexibility and protection. However, with this rise comes greater scrutiny. Compliance, reporting, and transparency requirements are becoming more stringent, meaning LLCs must be diligent in meeting regulatory standards. Lastly, tax law continues to evolve at both federal and state levels, which will require LLCs to adapt their strategies to remain compliant and optimize their tax positions. Understanding these key factors will be crucial for anyone involved with LLCs going forward. To wrap up, let's focus on the key takeaways about the law of business and business organizations. First, your personal assets remain protected, which is crucial for minimizing personal risk. Next, profits often pass through directly to the owners, helping to simplify tax considerations. Management structures tend to stay flexible, allowing businesses to adapt as needed. Formation of these entities is relatively straightforward, making it easier to get started. And importantly, the business entity is treated as separate from its owners, which supports clear legal and financial boundaries. These points are fundamental to understanding how business organizations function legally and operationally.